We're in Denver, Colorado at EnerCom's 19th Annual Oil and Gas Conference. I'd like to welcome Ken DeCubellis, the CEO of Blackridge Oil and Gas. Hi, Ken.
Good morning, Quinn.
Blackridge is focused purely in the Williston Basin. You just announced your company's strongest quarter results. Tell us about that.
As you mentioned, the second quarter was the best quarter in the history of the company, highlighted by our production, which came in at 715 BOEs per day on average for the quarter, and adjusted EBITDA of $3.6 million. The production grew on a year-over-year basis at 150%, and the adjusted EBITDA on a year-over-year basis grew at close to 200%. Even more exciting for us, now that the quarter's behind us, when we look at our balance sheet, it's really starting to loosen up. Our leverage ratio on a run rate basis is right around 3, which is really phenomenal for a company our size that's growing at the pace we're growing at. So all in all, a great quarter for the company.
Can you talk about the wells in your development pipeline?
Yeah, sure. First of all, we have a very active development pipeline. We're trying to be as transparent as we can on that with our investor base by updating that on a month-to-month basis. When you look at the ratio of wells that we have drilling and completing over what's in production, we're still right around 30%. That's a phenomenal leading indicator for future production growth, and we're excited about that. Now, when we look out here over the next few months, we're excited about the Mandaree wells that we're participating in. It's 5 gross wells. We have 12.5% working interest in those. We expect them to start up in the fourth quarter, operated by EOG in their prolific Antelope prospect in eastern McKenzie County. So when those wells start up, they have the potential to have a really positive impact on the company's production and cash flow.
Ken, how are you thinking differently today about growth and returns than you were, say, 2 to 3 years ago?
You know, we've always had a strict hurdle rate of 30%. With that said, 2 to 3 years ago, it was very difficult to meet that. With all of the operators drilling to get their leases held by production, we saw drilling and completion CapEx get a little bit too high. It was a little out of control. We were in some wells that drilled between $12 and $15 million per well. It's very difficult to hit those hurdle rates at that kind of a cost basis. Today, we're seeing the opposite occurring. Now that the leases are held, the drilling and completion CapEx is dropping significantly. We expect to average well below $9 million per well for the year. And then on the end of this, we're seeing the best operators, a lot of our partners, start to implement new technologies on the completion side. And as a result, the EURs, or production, are increasing at a significant clip, in some cases 50% over some of the older wells. So we're seeing a lot of opportunity now for high return projects in our inventory today.
Could you tell us about your non-operator business model?
Sure. It's pretty simple. Just overall, what we do is we take a small working interest ownership percent in a drilling unit. We then pay our pro rata share of the CapEx and get our pro rata share of the oil and gas revenue on the back end. Now, strategically, I would say that the non-operator model is really a perfect fit for the state of development in the Williston Basin today. The big argument against or the criticism about the model a couple of years ago is that non-operators didn't have a lot of visibility into their CapEx budget, that it couldn't be more polar opposite today. We have all kinds of visibility into near-term drilling, and as a result, we're really excited about the potential for the company over the next 6 to 12 months. And then the last thing I would say is on the non-op side in the Williston Basin, it's very fragmented. So if you're going to be a small non-op player, you better have the liquidity to participate in the drilling, and we do today, which is very exciting.
Let's talk about the capital markets, your balance sheet and liquidity.
Okay, speaking of liquidity, we hit a great milestone last year when we closed on a financing with our partners at Cadence and Chambers. They're great partners, really helping the company grow. And so at the end of the second quarter, we had $44 million of debt, another $11 million of availability, but we're in the middle of a semi-annual redetermination right now with Cadence. We expect to announce the results of that, and obviously we expect a significant increase in our borrowing base. We'll announce that over the next couple of days. But as I look to the next 6 to 12 months, we can continue to grow at a nice clip and maintain the relationships we have with Cadence and Chambers. We don't need to look beyond them for liquidity, so it's really exciting for the company.
Well, Ken, we wish you continued success.
Thank you very much, Quinn. It's great to be here today.
I'm Quinn Nguyen for oilandgas360.com.